Hello, everyone, and a very warm welcome to today's Major Markets Update for Saturday, December the 7th, 2024. Thank you for your patience. I had to postpone this a little bit due to some circumstances. But here we are, and in today's webcast, we're going to review the daily charts of the major indexes, and we are going to look at market breadth because there are certainly warning signs. Now, as always, price is the final arbiter. Price decides where the market is going to go next. And as long as price stays above the warning levels for the bulls, there is nothing going on. But breadth looks pretty dismal under the hood. However, a strong rally over the next 2-3 days can completely erase it. Remember, a market can always subdivide. If we have 5 waves up, it doesn't mean we will correct. The last 5th wave can then subdivide into another 5 waves. Okay, that's just why we need to break below certain key levels. That would be the start of that 5th wave in this case, to really be certain that is not going to happen. But these warning signs are there, and we need to review them so you can take that into consideration. Again, we believe the market is somewhere here and needs this and this wave. Okay, we're in this 3 and needs this wave. Of course, the smaller 4-5 can still happen, as I said, but if we break below the 4th wave low or the B wave low, then we're in this larger 4th wave. Why do I say B wave low? Because it is most likely in a ending diagonal. Again, we can't have it right all the time. That would be really nice. I would not be sitting here. I would not be talking to you, and you would not be listening to me, because we all would make money 24/7, 365, like it was raining cash. And that is, of course, not the case. The stock market is one of the most difficult things to master. And that's why we need all the help we can get. If you think it's easy, then you are in the wrong profession. It takes a long time before it's easy, and even then, it's not easy. It takes a lot of hard work to make it look easy. There, this is the Dow Jones, starting with this index. Again, there are enough waves in place from this B2 high from mid of November. We've broken below the first warning level for the bulls, the blue one, and that's it. We haven't even broken below the second one, which is at about 44,400, I believe. If we go below that one, it really starts to increase the risk for this red wave 4, and then we still get a red wave 5. Okay, 1, 2, 3, 4, 5, very extended wave 3 in that sense. And we got close to this target zone, but not really. So please pay attention to this pattern here that we had from August into October. We had 1, 2, 3 touches for the MACD. So far, we've had 2. Then we had here in late September, kind of like a sideways mess, something that we're seeing here as well. Okay, late September into October, we definitely had improving money flow. It was definitely stronger than now. So that's the big difference. But otherwise, this can still happen that we do a third tag. Okay, so this was similar. And we're going to turn around. That's what I mean. That's why price is final arbiter, regardless of market breadth being so bad. You cannot trade on market breadth only. Most of the time, you will get burned because the market can completely plaster it over. And what does it show? That the market is mostly leading by big cap stocks. The big tech is currently leading. It's fine. It has happened many times before. That is not necessarily a bearish sign. So here is then the regular NASDAQ. It is in the target zone for the C wave of the third wave. But again, I have zero signs that a top is in place. I would really want to see it drop below about 19,300 to consider it for in this red wave 4, and then we still have the red wave 5. I'm still missing a 4 and a 5 on a larger degree. So even if we correct somewhere around 5 to 7, maybe 10%, but 5 to 7%, I still think we get a larger 5th wave. NASDAQ 100 has reached all its target zones for the orange C wave, the gray C wave, the green C wave of this third wave. But also here, zero signs of a top is in place. So all I can do is raise the first warning level from Thursday's low to Friday's low. That's the first warning level. And the second, third, and fourth one, I'll keep the same. Okay, the gray, the orange, and the red one. And you can see exactly where they are from the charts. So that's all there is to it. So this is nothing bearish. Friday was nothing bearish at all. Yes, we have some bearish divergences develop on this index, but not by too much. Nothing where I say, oh my God, this is really bearish. The trend is still 100% bullish with price firmly above the rising 10, 20, 50, 200-day moving average and Ichimoku cloud. In the end, yes, I'm still missing this red wave 4 and red wave 5, but you can see that depending on where this fourth wave will bottom, the upside from 3 to 5 is of course not as much currently as it is when you buy the bottom for 4, right? You want to kind of ride the right trends. So then maybe there's 10% upside potential left for this larger top, the red wave 5 of the black wave 5. But from here to 20,000 to 22,000, there is, of course, a lot more left, right? That's what I mean. S&P 500 is also in our target zone. And there are, again, enough scribbles in place to consider the red wave 3 complete. But we haven't even broken below the now raised first warning level, which is the blue one at Thursday's low. So I want to see price break below that one on a closing basis, okay? If it breaks below on a closing basis, we start to make the first lower low, which is the premise for a bearish sequence. Bullish sequence are higher highs, higher lows. Bearish sequence are lower lows, lower highs, okay? So we need to start off with a lower low, and then we need to have a lower high and then another lower low. See that what I mean? And so far, we only have higher highs and higher lows. And that's all there is to it. Again, there are enough scribbles in place to consider the wave complete, red wave 3, but it can also still subdivide, so we need to break below these levels. That's why price is the final arbiter. Semiconductors are still stuck between the 4 here and the larger ABC there. Okay, I cannot discern between the two, but I know below which price levels or above which price levels this one or the two is going to transpire. So this one is, of course, less certain than that for the S&P 500 and the NASDAQ, where I simply have one wave count and I'm just unable to provide a good alternative other than it be hyper bullish, honestly. IWM is definitely also not looking great. Topped 2 weeks ago and it's below its first warning level, but not yet below its second one. So also this one can still decide to subdivide, my friends. It can still do it, okay? Just as it did here, all these ABCs, as you can see here, what mess. We can still do the same. Just because we have technically enough waves in place doesn't mean that this orange wave C cannot decide to subdivide also in a blue ABC. So this was then not orange, but an A of C, B of C, C of C. That's why we need to break below these warning levels. Until then, yeah, risk is increasing, that's for sure. So please take that into consideration. If I look here at the bullish percent index for the S&P 500, which is a measure of how many charts are bullish that make up the S&P 500 of the 500 companies, it's about 70. So that's still a decent amount. But you can see we're starting to get these negative divergences between, I would say, August and now. Also here, the bullish percent index for the NASDAQ starts to see potential negative divergence, rising prices, but a lower high on the bullish percent index. Previously, it was all positive divergence, as you can see, right? So higher highs, higher prices. And this is just potential. It has not been confirmed. It's just potential. So please be aware. This is definitely concerning. AD line is making one, see here over the last 1, 2, 3, 5 days. So the whole week pretty much lower lows, but the S&P 500 keeps increasing. So this starts to suggest liquidity problems. Okay, this is negative divergence. Again, a strong rally can completely erase it. We've had negative divergence before between the October and the November high, and all we got was that dip into the mid-November low. So there is negative divergence. It's another warning sign. Things are not looking that great under the hood, but we have not seen a breakdown yet. But keep this in mind. It's not looking too great. New lows are starting to increase for the NYSE and the NASDAQ as well. Triple digits for the NASDAQ and almost 60 for the NYSE. So that's also concerning. So you see the internals are not great. But again, a strong rally would completely negate this. McClellan oscillator for the S&P 500 is not great either. It's been increasing price, but it is completely dropped from 60 to minus 30. This, however, means we soon have a lot of upside potential left. If you look, for example, here between August and September, see all this decline, But what did price do? Higher and higher and higher. Okay, so it's not really can all do all warning sign, throw everything in the kitchen sink, out your window, all that stuff, and the baby and your wife and your dog and all that stuff. Not at all. It is concerning. That's for sure. So please keep that in mind, that internals are not strong. But as you know, a 2-3 day rally can completely negate it. As such, the summation index is close to a sell signal again. We had a buy signal late November, and it's turning into a sell signal. Okay. Now we've seen sell signals before, and the market increased, as you saw here in May, June, and July. Market increased, sell signal. Okay. We saw it here in 2023 between April and June. Sell signal, market increased. We saw it here in the beginning of the year. Sell signal, market increased. So once again, it is not necessarily the indicator that will tell us this market is going to go down. We have plenty of examples that the market completely ignores it and then resets itself. Okay, but there are definitely warning signs. I cannot state it often enough. How we're doing on the PMO buy all. Don't pay attention to this. Never gave a confirmed sell signal. It is something weird on stock chart that I cannot erase. Anyways, we have an initial sell signal again. So also this one is starting to suggest looks a little toppy. And then last but not least, our longer term model is still 100% bullish. So there you have it. Price, besides the SP 500 and the small caps, has not even broken below the first warning level for the bulls. The semiconductors is still a little bit stuck between a rock and a hard place. And market breadth is definitely deteriorating. It's telling us there are warning signs under the hood, but we need to see those breakdowns to confirm all these divergences. A Fed rally can completely negate all these divergences. So please do not short this market yet at all, because we have zero confirmation of a top is in place. Hopefully we'll get it this week. That'd be great, because then we get the wave 4 going, and then we get the wave 5. Plenty of opportunities. For now, take appropriate action with raising your stops, taking partial profits, all that good stuff, okay? And then if the market continues to rise, well, at least you will not get your butt kicked, and you still have exposure. And you can always add more. It's always good to add to winners, never add to losers. And with that, I'd like to sign off. Have a great weekend, and I'll see you all later next week.